Well, hello folks, welcome to another episode of Financial QB TV, and I am your host, Richard Reyes, Orlando's only financial quarterback and investor coach, and I'm sitting here at Timopunk Country Club to give you this episode. No, not about golf tips, but we're going to talk a little bit more about risk and let you know that not all risk is created equal. Last week's video blog, we talked about question number 16 of the 20 must-answer question, which states, do you have a number by which you can measure portfolio volatility? And that's when we talk about standard deviation. Well, today we're going to talk again that not all risk is created equal, because I hear oftentimes where an investor says, yeah, I know I only have one stock or two stocks, but I like to take a lot of risk because risk equals reward, right? Well, as the only place on the net where we tell you the truth, I have some good news and I have some bad news. The good news is that only the right types of risk have a higher expected return, i.e. in the long term, okay? But there is some bad news, and it is, again, that not all risk is created equal. Let me give you an example. You see, we're in this golf course, and let's say one of Florida's thunderstorms decides to pass by, and I see a bunch of lightning. And so I take my golf club and I raise it all the way up in the air like that. Well, of course you know that I'm taking some risk, right? I am. But is there an expected return or expected reward with that risk? Well, probably not. Probably an expected penalty, right? Because I can probably die if lightning hits it. But best case scenario, I can probably, most probably catch a cold. So as you can see, not all risk has an expected reward, and that is true about investing. Investors take all kinds of risks. Okay, and most of it's stupid and most of it imprudent when they invest in an individual stock, or because they think they work for this company for 30 years, they have some sort of insider secret that not even the CEO knows about, and they could expect a return. But whatever it is, there's all kinds of imprudent risk with a zero expected return. As a matter of fact, probably an expected reduction in return to your portfolio. So only the right kinds of risk have an expected return, and that's what you need a coach for.